A warm welcome to our presentation here today. I would like to introduce first and say hi to the new CFO in Protector, so Vibeke Krane. Could you wave a little bit behind there? So after a period of some kind of problems with the CFO position, we finally understood that we had to recruit a woman. And she has some kind of an experience also in Protector, but have a good and relevant background and to enter the position. So a warm welcome to you, Vibeke, even though you will not play a role in this presentation. I do have some support from one of my colleagues, Mr. Henrik Høye, who will step in and talk about our attack on the UK market. He has been previously in charge of setting up Protector in Sweden, then in Denmark. He's running the biggest organizational unit in Protector in Norway today, and has also been the project leader for setting up UK. And it's happening now when we speak in UK, so I think it's rather relevant to introduce Henrik a bit later in the presentation. If we go to the DNA foil, this is who we are. We are different. We will always remind ourselves on the main targets of the company. These kind of targets, they were established 11 years ago. And basically, I think it's right to say we have delivered cost and quality leadership, which normally leads to profitable growth, which again will lead Protector into top 3 position in any market segment we enter. So when we enter parts of UK market, our target is to be one of the 3 big players within the selected segments we enter in UK. So these kind of ambitions, they will always follow Protector. And it's good to start here to remind you about the main targets, so you can kind of evaluate 2016 and onwards to see whether we are where we should be and whether you think we are heading the right direction or not. If we start with the kind of highlights on our figures in 2016, I think there are 4 important figures on the screen. 1 is bad and 3 are good. If we start with a bad one, that is the combined ratio. 97 is not at all a good target, and it is 2 percentage points above our previous guiding. That is not good. That arises from further reserve losses on workmen's comp, the workmen's compensation product in Denmark, and from a technical change with a certain product in Sweden, where we have changed accounting practices, which gives a lost volume in Q4 and lost profits in Q4, and a very high cost ratio in Sweden in Q4. This is technicalities only. That volume will appear in the following 3 to 5 years in Sweden, and that profit will come back. It's an area which was rather small 2-3 years ago. Didn't really matter whether we used one or another accounting principle. And now when this product has grown bigger, it was about the right timing to check out whether we are doing it correctly or not. And our new CFO have decided that this is slightly on the wrong side. Let's correct. So this is a technical issue, and that is kind of maybe 1 percentage points out of the 2 we missed on the target 95, which we communicated to you around 3 months ago. So this is the weak spot. The question is, will we continue to deliver a high combined ratio, a poor combined ratio like 97, or is the underlying reality better, and or will that figure improve in 2017? I think that is one of the main questions here today, and I should put some focus, of course, on the issue. So that's the bad news today. The good news is that the return on investments continues to be very strong. We have an extremely strong 7% return on our investment portfolio in 2016, which is, I guess, more than double of what you should expect from the average insurance company in the Nordic area. In my opinion, it is not because we are loading up with risk, but we have slightly more risk on the equity side, not at all a lot of risk on the fixed income side. And I think it's fair to say we have performed better than peers 2016 again. I'll come back with some kind of figures. So the second important figure is the very strong investment result, size 7 on an annual basis. The third strong figure is, of course, the growth level, which is 21. And as you understand, the strong investment kind of return in together with a rather poor combined ratio, or a poor combined ratio, leads to a 21% return on equity. Of course, there is a fifth figure here, which is the cost ratio of the company, which we now and then are kind of forgetting. We are probably world leading on cost. That's not bad, and it's improving still. And it's still room for taking that cost ratio down, not in 2017, but in 2018 and onwards. I'll come back to that a little bit. So 4 or 5 figures which are important on this page. One is bad, at least 3 others are good or very good, and the fifth one is, as always, very strong. This time I've also kind of given a kind of highlight, a summary, so that we can update you a little bit on the different business units in Protector. So there are a few comments here. Commercial and public lines of business in Norway, very profitable, but competition is rather high in the market segment. It's single-digit growth, and it will continue on a single-digit level in 2017. Change of ownership, as you may remember, started out the year with reserve losses in Q1 and Q2, which influences a lot on the poor combined ratio size 97 in the full year. While we have communicated, and today also can communicate, that we are back on track, back in black, and we do expect either a rather good year in that segment or a very good year in 2017. Denmark, as we knew very well after Q3 and have kind of confirmed now, it would be worse, I said, a quarter ago, before it gets better, and it is worse, and even slightly worse than what I anticipated 3 months ago. There are a number of changes done. I'll come back to that on Denmark. Sweden and Finland. With Sweden, of course, with volume, Finland is very limited business at the moment. Everything is fine. It's moving well. It's profitable. It's growing. It will continue to do so in 2017. And UK, Henrik will then be back and talk to you about UK. Now it's happening. So last year we prepared and learned. Now it is happening in UK. On the investment side, we will kind of turn towards a slightly more conservative fixed income portfolio at the moment. We have done that the last 6-8 weeks. And that's not kind of a firm statement for the full year. But at the moment, the risk we would like to take is on the equity side, and we are lowering the risk on the investment side, on the fixed income side, which has not been a good move in the last 4 weeks or so. But okay, that's the kind of position we are taking on the fixed income side at the moment. As normally, feel free to ask questions through the presentation. There will be an opportunity at the end of the presentation also, but if you have any questions, feel free to raise your hand, and I'll then repeat your question. So we will not go around with a microphone. So give your question, I see whether I can respond. Okay, the written premium level, we are guiding on a 16% growth this year, 18% in local currency, which is rather close to 2016. So our expectation is that the growth will continue, and a lot of that growth has happened already. Not because it is linked to January 1st. Some of it is linked to January 1st, but we have signed a number of large contracts already in Norway, commercial sector, in Sweden, commercial sector, and in UK. So this is kind of hard volume. It is signed, it's committed from the client side. So the downside on the volume guiding is very small. Of course, there are renewal situations. We could lose some big clients during 2017, which have not been renewed so far. So of course, there are always some kind of down risk. There are at least one very big client which is up for competition, and we might let that client go, depending on the price development on that particular client. So there are what you could call smaller downsides, but basically it shouldn't be any risk on the volume side here. So 16 is solid, it's good, but it will happen later in the year than what you normally see, because those contracts which we have on board, they will have renewal dates gradually through the year, and a lot of it in quarter 2 and in quarter 3. A rather limited quarter 4 volume so far. What we have kind of picked up as an update for you is what's the kind of long time situation in Protector. And what you can see here is I guess you agree, a pretty strong story. We are growing 20% a year, 11, 12 years in a row. That's not bad. And we deliver an average return on equity sized 24, which is twice the average of the banking industry in Norway, I guess, in the Nordic banking industry. So if we kind of continue to do something like that, it will become something interesting, will it not? So I think that if you could please name 3 companies in the Nordic area with a similar track record, I'm all ears. So, one maybe? Ole Petter? You got the picture in the Nordic area, don't you?
Well, I would like to compare anyone to Protector.
Okay, that's the right answer. You can't really compare anyone with Protector. So thanks a lot. It was not kind of a planned question, so I didn't ask him to give that kind of feedback. The question is, what do you think about future? Will this kind of the poor figure, the combined ratio 97, will that kill the future opportunity of Protector, or is it another kind of situation? So our kind of long-term targets, as you know, is 15% growth in the midterm, which means 3 years ahead. We think we have a good visibility at least 3 years ahead. So we are not afraid to say 15 should be kind of expected for the next 3 years, with a rather healthy combined ratio, which we today communicate to 92, which has been 90 or 92 the last years here. And if we can deliver only even close to that kind of guiding, the return on equity with a normalized return on investment, a normalized one, not a very strong one, we will keep delivering 20% return on equity and growing at the same time. So I think it's fair to say that when we have the kind of this morning State of the Union dialogue with all the employees in Protector, we are reminding ourselves of the bigger picture. We are kind of growing rapidly. We will continue to do that. We have demonstrated a capability to give a very strong return on equity, and it's still our ambition to deliver that, formally guided to be above 20 then. And as you can see, here are the kind of countries that we have established a presence in, And you can see the timing then. Sweden in 11, Denmark in 12, and then both Finland and UK in 16. But volume-wise, starting to move now in 17. No plans for new setups in 2017 or early 18. So we will not do any activities the next 6 to 9 months on any other country, probably not the next 12 months. UK is a significant market, very big, and now we concentrate on our Nordic home market and on UK. Okay, just again, we are a bit worried, together with you, of course, about the workmen's comp reserve development and strengthening in Denmark. But again, in a bigger picture, we can see that the level of short tail continues to increase. And when you enter UK, it's more likely to be a situation where property and motor business, which is basically a rather short tail product or a very short tail product, that part of the volume will normally be higher than the short tail element you see here. So entering UK should not mean increased risk on long tail products. It should kind of support the idea that short tail will continue to grow. In addition, with a reduced appetite on long tail business in Denmark, it's likely to see this figure grow to above 60 or around 60 in 2017. Okay, so let's talk about the 97 figure a bit more, and I think this foil here is crucial for the understanding of where we are profitability-wise on the technical side in Protector. So what we have delivered to the market in 2016 is a combined ratio 97, which consists of a very high claims ratio and a very low net cost ratio. We can run on a net cost ratio around 3. This has to do with the reinsurance part. So the gross cost ratio is 6.8, while the net is normally around 2.5, 3. Let's say 3 in that area, which means that we can run claims ratio 89 and deliver a combined 92. That's normal in Protector, because our reinsurance proportion is slightly higher than compared with the other companies in the Nordic area, and that creates kind of a net cost ratio, which is even lower than the gross. The gross is the important one. That's the one you should put your eyes on. That's what we are following up. So these kind of profits would have ended back in Protector with a more limited reinsurance portfolio. We would deliver basically the same profit or a slightly better profit, because we don't earn money at the moment on the reinsurance contracts. Reinsurance World do, which is normal, which they should do. Okay, so the question is, if you kind of are looking at the reserve losses or strengthening, two words, same meaning. Losses is a kind of simpler word. The reserve losses you have seen this year, in our opinion, this is a figure that will not repeat itself, and it belongs to previous years. So if you distribute that figure to the kind of risk year where it actually belongs, you will see this picture. So the combined ratio of Protector the last 4 years is around 90, but slightly going upwards, slightly. So when we enter 2017, the most relevant figure to look at is this one, is 91. So in my opinion and in our opinion, we are not moving from 97 to 92 in the guiding. We are moving from 91 to 92. That's the reality. Of course, you might pop the question, will you see more reserve losses outside what you expect today? And it's not possible to give a very hard answer to that. We had been wrong about reserve losses on the reserve side in 2016. My apologies to you on that one. We didn't see it. My answer today is that I feel comfortable in all areas. However, there are still one risk area, that is workmen's comp in Denmark. Because that is far too early to be sure whether we have sufficient reserves or not. We think we have. The actuaries have been working. Everybody has been through the figures. And as you will see on a later page, the relative influence of the company in 2017 is rather limited or very limited when it comes to that product in that country compared with the totality. So in my opinion, very, very important statement today. We are moving from 91 to a guiding of 92. If you believe that and think that we will have a normalized investment income the next 3 years, you should buy more shares. If you do not believe, you should either stay or walk away. And I'm looking at my son, what's your decision? Because you take your own decisions today. Normally I say, my advice to my son and daughter, they have shares in the company, and you are buying a new house, I understand, at the same time. So do you have any plans to sell your shares in order to finance your new house, or would you like to stay?
I'm going to stay.
I guess I knew the question, but I couldn't be absolutely sure then. Okay. Normally I'm rather concrete on this myself. You know, I'm a rather big shareholder. I guess I'm on the top 5 list of the company. So my statement to the market, I will not sell. Okay? So that is it a promise? Yes, it is. So for a long time, I can't give it for forever, okay? So let's meet a year from now then. And then I should repeat that statement then, a year from now. Is that a fair deal? I will not sell. Okay. So at least I do believe the story. I walk the talk in that area. We are the cost leader. It's some ups and downs. 6.8 is good. Underlying realities are slightly higher. So it's not important. So we will end up around 7, even if UK is entering with volume now. We will not continue down this year. But again, this is extremely good and is not very important. In 2018 and 2019, you will see another step down on the cost ratio in Protector. Okay, Denmark. This is the kind of figure story which you have heard is bad. This foil, I guess, is a bit more important then. So the country manager in Denmark, he steps down this morning, but he's an okay person. He is still wanted to be in the company, and he will continue in the company probably until the end of the year, maybe longer. There are no kind of payment situations. There are not any financial things to say. So he has a contract. He will be paid when he's working, and when he is not working in Protector, he will not be paid. So that situation has been sorted out in a smooth way with a good dialogue between the company and the country manager in Denmark. We are now starting recruitment of a new person to be in lead. And I'm sorry to say that we do not have a number 2 person in our organization in Denmark. So that person do not exist internally in our organization. Normally, we are looking to replace all managers with people from inside the company. We do not have that situation in Denmark, unfortunately. So at the moment now, head of business development with 20 years background from financial industry and has been working in Protector for a year now, Erik Sand. He is today located in Denmark. Will live there and stay there on average 4 days a week at an estimated time 9 months, which it takes to kind of increase quality, efficiency, and take back what we could call a full business control in the Danish market. The good story here is that the kind of trouble we have in Denmark, which partly is created by ourselves, not by the market, but by ourselves. We have seen it for a small year, and actions have been taken. Of course, if we hadn't taken any decisions and initiatives the last 12 months, today it would have been too late to improve anything in 2017. But actions has been taken. We have increased prices very much on some affinity programs. They are still on board. So let's say the accumulated affinity price increases is around 50 million, slightly above 50 million. And then we have added on prices on some individual clients, some very big ones and some medium big ones. So let's add 15 plus million on that list. And then some clients are priced out, both in the affinity market and in the commercial market, the one-on-one client market. That is kind of expected to improve profitability. It's not obvious, because it's not obvious that the client who had a lot of claims in 2016 would repeat them. But in some products areas, you know that they will be repeated. So price up, price out, and some other initiatives in Denmark will improve profitability, everything else equal, with a level between 80 to 100 million. Let's be a bit conservative and say 80. And we have 650 million Norwegian kroner annual premium in Denmark. And if you improve with 12 to 14 percentage points, then you are back on 100. And if you have taken on board some new clients, for instance, in the public sector, we are getting close to be number one on public sector also in Denmark. So January 1st renewal in Denmark was a rather poor date. We got the price increases we needed, but new sales was very low, with one exception, public sector. So we are the public sector specialist in the Norway area, with close to 1 billion Norwegian kroner annual premium. This is short-tail business. This is 95% short-tail business. It's not workman's comp. We are not afraid of this kind of business. And it's not volatile, because the main risks in that portfolio is fire risk on buildings or storm risk on buildings, and we have reinsurance contracts for these kind of situations. So this means reduced risk, increased volume, increased margin in the market. So I think it's fair to say that it should be rather realistic, even if some new surprises occurs in Denmark, to be profitable in 2017. But I have given a written statement on that, okay? Because you are kind of on the edge to profitability in Denmark. At the moment, I think that we end up in a profitable situation in Denmark at the end of 2017, because actions were taken in quarter 2 16, quarter 3 16, and quarter 4 16. And now we are preparing for 2018 and 2019, also with the kind of management changes we have done in the market. Yes?
Question regarding the split between short tail, medium tail, and long tail in Denmark.
Yep.
What's it currently, remind us please, and on the new sales, how does that distribution look?
Yeah. So the split, I think it's around 50-50, long tail and short tail. Looking a little bit on you, Vibeke, so I get that's rather confirmed, so 50-50. And on the new sales side, it's more like 90 short tail and 10 long tail. And if you are not looking into the price increases, which is good, which is volume increase then, okay, but that's kind of one client to 100, the same client 115, that's accepted, I guess. But there is a rather rapid shift on risk appetite. So from 50-50, new sales 90-10. But we are not out of the workman's comp market in Denmark. We are a bit afraid to swing too long on the conservative side. We have been very profitable in these areas in the Norwegian market the last 5 years. Very, very profitable, both before and after investment income. And investment income on this product is very significant. So you can easily run a combined ratio a lot higher than 100 on that product and still earn money. if you have a normalized return on investment portfolio in that area. But okay, good question. Long tail 50, short tail 50 in Denmark, new sales 90-10 on short term. Yes?
What's your reserves on the long tail part number in absolute amount?
350 million, Vivek, or is it somewhat higher? 500? Is that something like that? Okay, so closer to 500 million accumulated reserves in Denmark. So if you have a kind of a potential reserve swing then on 10%, it hits you with 50 million, which is kind of a figure which could arrive if you have further problems in the Danish market. Could hit your profitability with 50 million. So, okay, this is good. Everything else equal, you are back in black. But if you are getting more reserve losses in Denmark, it could influence still the profitability, but not at all on a very significant level. That is 1.25% of expected volume in 2017. More questions about Denmark? Okay. So the ambition is to do a comeback in Denmark, and my opinion is that the team is working hard and will deliver that. But some kind of uncertainty in Denmark, of course, but very significant improvements done already. Okay. Yes, another question?
Did Flemming say why he would like to be sales manager instead of country manager in Denmark?
So the question is whether the country manager, whether he expressed an opinion on the fact that he is moving from one role to another. It is not a situation where the initiative was on his side. So the initiative was on my side and on the company side. So I guess that Flemming's position was that he would have liked to continue, and he thought he was good enough to continue. This dialogue has been going on for a period of time. Obviously, I have another opinion on the matter. We are rather open in Protector when we talk about these kind of things. It's a rather civilized dialogue. He is a civilized and professional person. So it's not his kind of preferred role. It's not. So he has to kind of to taste that role for, let's say, half a year now. He is an important person in Protector in Denmark now in order to rebuild the quality and the credibility, which we to a certain extent have lost in the Danish market at the moment. So he's an important person. If his taste of the new role is positive, and if we like what we see, he will continue. If not, he will leave permanently down there. It takes time to see. So I think that both parties are open for an option to continue. Normally, that's not a good idea. But we have done these kind of management changes in Protector in earlier years. We have 2 people working in Protector as we speak, which has been a part of my management group, which is not today. They are working very well in the company. They are very good at where they are. So we have done it before, but normally, as you agree, this is normally not a good idea. But we will give it a try, and we do have a mutual respect, and I'm absolutely not worried about the situation in the next 6 months. Okay?
And finally on Denmark then, what's the underlying combined ratio if it's 91 for the company? What is it in Denmark underlying if you think about that number?
Slightly below 100. So the underlying profitability and the underlying combined ratio of Denmark was the question. 113 as you see on the screen, this screen, and slightly below 100. It's not an impossible market to make a profit in. Our competitors are profitable in the Danish market. It's not a crisis market. It's we who haven't played the game good enough. Okay, so then Norway, there are rating pressure in what we could call the personal lines of business. So we are stepping a little bit back volume-wise in Norway at the moment. It is a profitable business. We are growing single digit. On property and casualty area, it's still a healthy price situation, while in group life, other illness, workman's comp, the pressure is higher. So we are withdrawing a little bit on the volume side in that segment. But that's not a problem on the company as a total company. We are a diversified company. We are in 4 or 5 countries, in 2 segments in any country, 3 in Norway, and we can handle it. So that's a part of the normal competitive environment we will have in all markets. Quality leader, 9th year in a row, very, very strong relationship with the broker world in Norway. And they and other brokers, they support Protector when we enter the UK market. Change of ownership, back on track, back in black. Some prices increases implemented in the change of ownership area. House prices continue to go up, which is positive to Protector. And we feel very comfortable with the reserve side on change of ownership today. So at least I will be very, very surprised if there are surprises coming out from change of ownership now. We have been back on track for 2 quarters. The number of unpaid claims is historical low, and the claims handling team, who pinpointed their own ambition to be best ever in claims handling at the end of 2016, they are, according to their management, and I support that statement. So I think we have never been more fit in this area than we are today. And this will be a kind of a good segment, although not relatively that big as in older years. Back in 2008, 9, 10, it was very significant. Today, this is more like 12.5 to 13, 14% of the totality. Sweden, everything is moving very well. The technical change in Q4 is not really relevant. It gives a small Q4 hit in Sweden, but is not anything to put any focus on.
So just,
Yep.
which product is that?
It's varmepumpe, heat pumps. So we are insuring the deductible for a client. So if a client in Sweden with a house with a kind of a heat pump circulating air around in the house, if that goes defect, and let's say you have a claim on 100,000 Swedish kroner, it might appear it's a leakage coming out from it. And then they pay a deductible. They are self-insured, size 5,000, and we cover that, 5,000. It's a long-tail product, but it's with an extremely predictable kind of profitability. And the main supplier of that is NIBE, which is a big European supplier of these kind of products. And our contract with NIBE is kind of hard written, will lead to profits. There are some side products which is not guaranteed to be profitable, but we don't see any profitability issues on the product, not at all. But it's growing. It starts to be kind of an accumulated volume. It does. So we are not accounting the written premium upfront like we do with change of ownership, and then reserve for the future claims. Now we are dividing that premium in, let's say, 5, which is the kind of period which the client is covered in that area. So many small policies out there in the market. Okay, so we are on Finland. It's moving. and we will take a position. Quality is good, but it's not an important part of the totality. So Henrik Høie, in charge of setting up Protector in, so I don't know whether I will have an applause, but he can have an applause when entering 20.
Thank you. As we've mentioned before, when we enter a new country, a new market, that is through public sector. And we enter public sector in order to get in a position and through the procurement rules, so a level playing field for all players. And it has been a slow start in 2016. The important part here is to get the right people on board. And I think the combination of getting well-educated, hungry, and good people on the analysis side, on the underwriting side, together with local competence. So when we did our analysis on public sector UK, we understood that the liability product is more complicated than what it is in the Scandinavian market. And therefore, one of the first employees was a liability underwriter with 30 years experience, Paul. And Paul also has experience in public sector. He helps us. On the side of Paul, we then have some young people, one who is a doctor in physics and who wanted to work in an insurance industry and with Protector, and another one who has a master's degree in mathematics. So good education, good test scores, ability scores, and with the right attitude. And then if you couple that with building extensive databases, in the UK at the moment we bought lots of data from the brokers. We have bigger databases in the UK now than Scandinavia in total, which makes us more competent, and the learning curve is very steep when we have these databases. I would say that the underwriting processes in the UK at the moment are at least at the level of what we have in Scandinavia in public sector. And when you get the breakthrough, which we have called what has happened now, and I'll give you an example of that later on, then you get some kind of a flow in this market. I think now we have understood that how to score high on the quality aspect of the award criteria in the procurement processes. And we are slowly gaining understanding of the market prices and the market levels. So we are better at hitting the right levels. Been a bit careful in 2016. Now we understand it better. So the situation now is better than this. We've also received some new awards, and the total number of clients in public sector at the moment is with a firm commitment is 35. If we go to the commercial sector, that's a few steps behind, and it takes longer, and that has to do with the building of relationships. So the first statement in our business idea, unique relationships. In the commercial sector, UK, there are a very large number of opportunities. And from the beginning, one of the most important things is, other than getting the right people on board, to focus our efforts. And in order to do that, we have chosen a few brokers to work with, not all of them. That would kill us because of too many opportunities. So we have a project, we called it 5x20, 5 broker houses, 20 brokers, individuals in each broker house. And at the moment, in practice, we're working with 3 broker houses. And we are looking for number 4 and 5. But it's more than enough to work with those 3. And we have become a part of a broker or an exclusive panel with one of the brokers. That's where we see the most business from. We have aligned our underwriting processes with the Scandinavian market, and we join forces. So instead of creating these boxes with a UK underwriting team and a Swedish underwriting team and a Norwegian underwriting team, we sit down either in a video meeting or we travel and see each other, and then we try to learn from each other. At the moment, we're learning both from the UK to the Scandinavian countries and, of course, from the Scandinavian protector way to the UK. So commercial sector it takes time to build relationships, and it is most likely a better idea to be a bit on the careful side from the beginning, and there will not be a lack of opportunities in the commercial sector. Bit behind what we would like to see, but compared to Sweden and Denmark at the same time, we are ahead. Okay, and we also see other opportunities, and as I said, to select what opportunities we want to go for is important. And then we need to check the opportunities with our main goals and our main strengths. When we were approached with an opportunity in the housing sector in the UK, we had to see, is this an area where cost leadership is important? Is this an area where quality leadership is possible to achieve? And is it possible to achieve profitable growth and a top 3 position? The housing sector is very similar to, in the UK, it's very similar to the local authority sector when it comes to competitive landscape. So there are basically 3 players in that market. One of the players is the same. So the market leader with 60% market share is the same as in public sector, Zurich Municipal, and is one of the companies that and maybe one of the best representatives for what we call fat and lazy. That situation is also coupled with a broker market who needs more competition, and we have been in dialogue with one of the brokers in this market, and we have received, again, a lot of data. So the size of the database that we have received on this segment alone is twice the size of what we have for Norwegian local authorities. And Norwegian, we have the whole market for Norwegian municipalities, kommuner. So this is an opportunity, and at the moment we think it's a good opportunity. So we are continuing working on it, and then we will see what happens there.
The relative long tail and short tail business within that segment, could you give a comment on that?
This is 90% property. It's housing associations.
So short tail.
Short tail. So the example I mentioned is London, and as we have stated before, we don't go for any prestige clients, because they are prestige clients. But when we see opportunities like 9 London boroughs in a consortium buying insurance together, and we meet them on the insurer day, where they present their risk management initiatives, which are of the better we have seen, and we get data on 2.5 million inhabitants 10 years back, then you start getting a good basis for making a decision if this is a good idea or not. And in our opinion, this is a good idea. This is profitable business for us. And at the same time, we think and hope that this will give us some credibility in the market. This is This is around 1,200 pages of tender documents for these local authorities. And to quote insurance on that basis is it requires some experience, and when you then win it, it has been through an award process and an evaluation process from the procurement offices and the brokers. So and the insurance market knows that. So I think we will gain some respect, and it won't matter too much in the public sector because of procurement rules, but hopefully it can help us also in the commercial sector. All right. First time we give some volume guiding on the UK. Of course, it's challenging to give a firm volume guiding on a market where 300 million pound markets pop up every now and then. But at the moment, what we believe in is that it is possible to achieve profitable growth of 150 to 200 million kroner in UK in 2017, and most of that growth will come from public sector, with 75% short tail. Lot of property business there also.
So, how much volume do you need to break even?
So this, at the moment, I would say that we will not break even in 2017, most likely in 2018. All right, so that's the area where we spend money at the time, but hopefully that will give us some results.
Yeah, and this is kind of, the wording here is, it's not very important. We say estimate and preliminary estimate. It's kind of not a hard guiding. It could end up differently. And I think it's fair to say that our attitude is that we don't really care. So whether that figure is 500 in 2018 or 800 or 250, there are lots of opportunities. We will be cost and quality leader. We have to do decent underwriting. And if we can find profitable business, we will go for it in that area. So we are not kind of putting ourselves in a corner where we think we have to deliver some kind of volume. It will be what it will be. It must be profitable growth. If not, we will stay away from the different segments in the market. But okay, an early estimate. Yes, a question?
How much of the 400 to 500 in 2018 is that housing associations?
I guess Henrik is right to say that we haven't really divided that too much into different sectors. So it could be nil, or it could be something in that area. So we do not have to have housing associations on the client list in order to reach these kind of figures. It will help, but we don't have to. Next question?
Can I just follow up on that?
Yes.
And then if you go back to slide, then you will have maybe the potential to almost double that number into 2019 with the housing associations if you reach 10% market share, right?
Yes, to reach 10% market share, 300 million Norwegian kroner, it would typically take 4 years, because the kind of renewal process is every 4th year on average. 3 minimum, 5 maximum, 4 normal in that area. So to churn 300 million pound round takes normally around 4 years. So to create 300 million should take 4 years then, if you take 10% market share. Normally we will end up higher than 10 in such a segment. We will. In these kind of segments, we would normally go for 25 or 30% market share, which is kind of a fair part of it. So market share wise, I think that we would normally think a lot higher than 10. But let's wait and see. Okay, another question?
What would be the public market split of products in the UK typically? If you think about the London example here, what is motor, what is housing, and what is workers' compensation, and typically other kind of business which you typically don't know?
So, like Henrik said, a kind of a 75% short tail and maximum 25 long tail. So it differs a little bit from segment to segment. Property in housing is very, very big, and in public areas it's very big in that area. So that will, as I said a bit earlier, kind of balance the Protector portfolio towards a more short tail situation. More property, more motor, and less kind of different liability products. But there is a big liability volume in UK, and in the longer run, I think that we will increase our appetite on liability sector in UK, because it's a lot, relatively speaking, a bigger market. Not workman's comp and what's called employee liability in this market, but other liability products. In the very long run, liability is of a lot of interest in the UK, but we will enter carefully on the liability sector, the long tail areas within UK. It's a competence game, and we know that we have some good competence, but only in certain sectors in the very, very huge UK market. So short tail, focus, some long tail may arrive 3 to 5 years from now, not in a significant volumes the first 3 years. Okay? You have seen the figures. It's actually the best operating profit figure ever in Protector. We are not speaking too high about it. Combined ratio is too high. It's poor. We don't like it in that area. But that figure is actually the highest we have ever had. And 3.439 million in volume. And if you multiply with 116, you are pretty close to 4 billion. So whether we will reach 4 billion in December or January, I'm not quite sure. But we will reach either in December or January. That's for sure. So 4 billion is 10.5 months from now, but I don't know whether it will be end of December or January 1st next year. The continued growth. On the investment side, we are, as I said a bit earlier, reducing the fixed income risk a little bit at the moment, and return on equities from insourcing Q4 2014 compared with the different stock markets in Scandinavia has been very, very good. And also the fixed interest portfolio has delivered extremely well. We normally nominate employees of the year every year in Protector. Let's say 10% of the employees. And we have 2 very good candidates in Protector this year. Dag Marius was the employee of the year last year in charge of equities, and Katrine, which is in charge of the fixed income portfolio. So this time it was then Katrine, the fixed income lady in Protector, who was nominated. So she go to New York together with other employees of the year then. So we are very, very satisfied with the results. The bad part of the story is, of course, that when spreads have been going down, like they have in 2016, we are running out of yield. So that's the bad part of the story, that the current yield in fixed income at the moment is closer to 3.0 on that. And that's our expectation, that it will kind of continue to stay around that level. Hopefully the interest rate level is picking up again in the world at the end of 2017 or at a later stage. So I think that, like Storebrand is kind of looking for an interest rate hike, we would prefer to see that as well. So the very good investment results we have delivered to the market the last 5 or 10 years has been despite the fact that our interest rate level has been rather low and is on all-time low level. So kind of a normalized investment income, you should go into your spreadsheet and think a little bit about it. Where will we go the next 3 to 5 years? Hopefully upwards again. But at the moment, it's running at the yield size 3. Yep.
You talked about the fixed income side in your initial discussions.
Yep.
You said you have done some changes already in January 2017.
Yes.
Could you just elaborate a little bit on those, if you can?
But what we did in Q4 last year and the beginning of this year is to go more conservative, reduce even more on the high yield side. Nothing in outside of Scandinavia at all, and more up to AA type of papers. Could be some AAA volume at the moment. So we are a bit more nervous in these markets at the moment, but at the same time, kind of allowing ourselves to have a relatively high equity part of the total investment portfolio, sized around 20. So we are on what you could call a rather high equity allocation, but then moving more conservatively on the fixed income side. So we think risk return on that kind of combination is slightly better than take equities down to, let's say, 12 or 15 and increase the risk on the fixed income side. Okay, and again, see the net combined ratio from 2009 to 2016, a rather stable situation with a kind of very, very good year here. But we are not far away from 90. Sometimes a bit below, and sometimes a bit higher. These kind of figures you have seen months before already. This is a change. 2 years ago we had 92. Last year we said 90. Now we are back on 92. We will be very, very, very profitable with 92. 94. We will be very, very profitable. If we continue to grow and have a normalized return on investment, this is a kind of a very, very good story in my opinion. I do not sell. We are one of the most solid companies in the Nordic market based on the standard formula, close to what Gjensidige delivered yesterday. So we are kind of equal with Gjensidige, despite the fact that we have more market risk on the equity side. Okay? So if we had taken over total investment portfolio a bit more to the conservative end, like taking down the equities, then our solvency capital ratio would have been higher than Gjensidige. So this ratio is after investment risk then. This you can have a look at if you would like to. The summary of the risk and outlook, we missed on one. This could happen. And that was reserve challenges. We didn't anticipate, we didn't see it arrive in that. So that's kind of not too good that we didn't kind of discuss with you these risk elements. This is new. But on the other risk elements, they kind of basically deliver what they should do. And I think today we have kind of some medium areas here. But so we could miss on Denmark. It's 15% of volume. And 7.5% of volume is in long tail of the total book of business in Protector. So the relative issue in Denmark is of course more limited. Zero growth in Denmark or single digit this year. The only growth coming out from the public sector, short tail products. So it's reduced risk in Denmark and everything else is growing, in my opinion, slightly more diversified portfolio. And we have had reserve strengthening in 2016. Normally it will not repeat itself. So I think we are moving into a territory with slightly reduced 2017 risk compared with 16. And the guiding, as you know, 16% growth, 18 in local currencies, which we got some help from the currency in 16. We make some 2 percentage points or something like that. Yes. So it's more like 19 and 18 in local currencies then. So rather equal. Same growth 2017 as in 2016. And again, to repeat the 92 versus 97 here, don't worry too much. It's from 91 to 92. It's not from 97 to 92. That's kind of the main point and your main question, or at least it should be your main question. But the investment side is beautiful. The balance sheet is growing. It will deliver something called a normalized plus a little bit, because our ambition is always to do better than you guys sitting here. You will question that, of course, but that's also our ambition then. And the kind of summary is the profitable growth story continues. It's a Nordic home market story at the moment, but we should prepare for UK. That will grow gradually to be significant in our portfolio. There are a very limited number of red flags in UK. And we are more careful about the most difficult product areas, where we also have shown that we got some trouble in Denmark. More careful, learn something, few red flags. It looks very, very good. Cost ratio is high, quality is low, and now we know more than we did a year ago. So it looks promising. Final questions? Yes?
As of today, is 0% your best estimate for the runoff result for 2017?
Yes. Runoff results 2017 close to zero. And then normally you should have smaller reserve releases on the smaller products where we still are doing accounting based on FSA minimum requirement, which is slightly more conservative. So I say a very small reserve gains could be normal, but then I think that something else will be strengthened and zero on the reserve side, yes. Another question?
Yes, on the dividend side, I just read your press release, and I have never seen this expression before. And this was that the board considered to recommend the 225.
It's a kind of standard formula, I think. So I think we
Is
should.
there any uncertainty about it?
No, not at all, but it's a formal kind of statement. So I guess that if you read the statement 1 year ago on Protector, I think it's exactly the same wording like last year. So we might phrase it slightly different than others, I'm not quite sure. But it's Mr. Chairman, you're sitting there, it's exactly the same statement we always deliver.
It's a technical issue. The General Assembly is deciding.
Yeah.
Of course. So, but you consider it's just not a considering.
Yeah, the accountants we would then have to prepare the accounts differently if we said we have decided the board. But take that up with an accountant. I'm not.
But okay, but the question is kind of relevant. Same phrasing we have used before. We are not at all worried about the dividend. If China crashes in March, we will come back and discuss again, of course, in that area. But if life is close to normal, there will be same dividend as last year.
Okay, thank you.
Yes, another question?
On the long term, and not 2017 guiding, but on the long term guiding for the combined ratio,
Yeah.
you are increasing it now to 92.
Yeah.
And you reduced it a year ago from 91 to 90.
1 year ago. Yeah.
Could you just discuss what made it then reduce it and what made you now increase it again with 2 percentage points?
Slightly increased combined ratio expectations in change of ownership compared with history. So even if that relatively is not very big, it influences slightly. And slightly more conservative, even more conservative view on the claims side on workmen's comp in Denmark. So those two elements are a bit more conservative than last year ago. And let's go a couple of years and see how rate pressure, which is kind of the long-term question, develops in the different market segments. We have communicated that we have had that for a number of years in the Norwegian commercial market, and that might also influence slightly on. In the previous year, that kind of rate pressure has been compensated by a significant reduction in the cost ratio, which is not likely to repeat itself again. So change of ownership, workmen's comp Denmark, slightly on the rate pressure side, and then, okay, 90, 91, 92, we are on 92 here, which we feel is prudent and will deliver brilliant results here. So Okay, I guess that's the three elements. It's the response. Another question to your question.
What about the reinsurance risk here? Have you seen any changes to your cost about reinsurance when your combined ratio is deteriorating a little bit?
Not at all. So on the contrary, so we have a very strong and good, thanks for the question, reinsurance contract signed for 2018 with Munich Re. That's behind us. And it is very, very good. And the basket of other reinsurance contracts for 2017 has been renewed to improved terms and conditions. So everything on the reinsurance side is either very good and equal or better on the reinsurance side. We don't expect any pressure from the reinsurance side towards Protector. Basically, the losses we see here on the combined ratio side is for our own account. It's workers' compensation of ownership. Has nothing to do with the reinsurance world. So the reinsurance world is very, very satisfied, and we have new discussions at the moment, which is of interest. There are solvency-based reinsurance contracts available, probably to a competitive price, which would be considered for the future. A bit early to talk about it. But we have no problems with the reinsurance world, on the contrary. Another question?
I have two questions, and one follow-up on the last one. If we look at the UK, which are now giving us more details to,
Yeah.
what would you say is the long-term net combined ratio guidance for UK?
So I guess it's too early to comment on that, because still there is a situation there are many segments. Housing is different from public, it's different from commercial, and commercial is many, many segments. The deductible level is from very, very small, £500, to extremely high, £250,000, £1 million, even higher. So it's a spread of terms and conditions which you can calculate any figure. So what I would say at the moment is that with the kind of competitive position Protector do have in the UK, we should target 92 in the UK until otherwise is stated in the market, which is better than competitors, which is likely to happen if we have half the cost ratio compared with, or even lower than half the cost in certain segments in UK. So 92 at the moment, but it's a mix of markets and segments, so you can find many figures in that area. More questions? Yes?
If I just can continue, I will be finished with the two last ones.
Okay.
With an entry into UK and the volume development you're seeing now, will there be any change to the retention levels, or will it be approximately the same? And then the last one, there's 14.3 million over costs, in all the costs that seem to be a little odd in the quarter. Could you just comment on what those costs are, please?
The first question is about the retention level, and that is also a bit difficult to comment on, because again we don't know exactly what kind of volume will arrive out from UK. As it looks now, I think that the retention level, the kind of business we keep in our own books, we go slightly down with UK, because we will see it more, because it's more property business relative to the average of Protector. So I think retention level next 3 years slightly down due to more property UK. And the second question was a cost element in quarter four, size 13 or 40 million Norwegian kroner, which is basically it's interest rate payment on Tier 2 capital. So if you compared quarter four with quarter four last year, we have 500 million more on Tier 2 capital, and that interest rate cost is calculated on that line in the profit and loss statement. Another question?
Yes.
You have prepared very well. Apologize for not opening up for questions earlier. We are running over time.
Just three of them. Is it more products which you have calculated the premiums in the same way as you did on these heating machines? Is it any other products is similar accounting-wise to this
No,
heating?
no.
Okay.
And if the answer was yes, I had to do something with it.
Then the combined ratio during 2017, it will then slide from 97 reported down to 92 during the year. How do you think the how will it look during the quarters? Will it still be like the variation we see in the Nordics, like high in the Q1 and higher in Q4, and better during the summer, or how would you?
No, I think that it normally it will follow Protector's pattern, which is slightly different from others' patterns, because we have a lot of reinsurance income in Q1. So combined ratio Q1 will normally be the kind of the best quarter in Protector, and Q4 the worst. So look at the pattern we do have and kind of expect that basically to be repeated, but slightly more kind of towards average, because UK will change this slightly then. But okay, yep.
And finally, the loss in the change of ownership. What kind of run-off loss did you have during 2016, and what do you expect for 2017?
0 in 17, and 15% of volume in 16. Reserve loss, change of ownership, 20. 2. Say it loudly. What? Okay, so even more than. Okay. Closer to 200 million. So the answer I gave was an accumulated Norwegian figure. We have also have reserve releases and gains in workmen's comp in commercial sector. So Norway, a large 100 million reserve loss accumulated in 2016, expected to be 0 in 17. Okay, so thanks a lot for joining us and listening to the story. So have a nice day, everybody, and nice weekend.